Breaking news this week. A 50-year mortgage and no more credit scores, and buyers either win big or get crushed. Everyone's talking about the idea of a 50-year mortgage. So let's break down the good, the bad, and the ugly really fast. The good, a longer mortgage means lower monthly payments. Using Orlando as an example, our median home price is about $420,000. On a 30-year mortgage, that's about a $2,500 a month mortgage payment. On a 50-year mortgage, it's only going to be about $2,200 a month, a savings of about $300 a month. But here's the bad. That payment and that savings comes with a huge hidden cost over the life of the loan. With a 50-year mortgage, you are likely to pay significantly more interest to the tune of $300,000 or more. So you will really be spending hundreds of thousands of dollars more. And the ugly, not only will you build equity extremely slow with a 50-year mortgage compared to a 30-year mortgage, about half as fast, but it could actually inflate home prices worse than they already are, which defeats the entire purpose to begin with. The only upside and silver lining to the 50-year mortgage is for extremely disciplined buyers. These are the people who are taking that savings and using it in a very uncommon way to invest elsewhere and make money that they can pay that loan down quicker. Now, let's be real. That is going to be a very tiny number of people, and the vast majority of people could find themselves in situations that far outpace their ability to pay for their mortgage, and we are right back to where we were in 2008. Now, the second huge headline this week was that Fannie Mae did away with credit score requirements. But don't be fooled. This does not mean that every loan does not have credit score requirements any longer. Government-backed FHA loans still very much require a credit score. The minimum is usually around 580, but with a large down payment can be as low as 500. But Fannie Mae as an organization itself is allowing alternative data like rent history, one-time payment, cash flow patterns to help people with thin or limited credit. More people can qualify for homes. So picture this, lower monthly payment plus an easier way to qualify. For some buyers, this could really open doors to home ownership for the first time in history. But if you don't fully understand the math, you'd end up with long-term debt that grows faster than your equity. This isn't really a good or a bad change. It's a tool, and tools can either build wealth or destroy it. So all of these changes that we've been hearing and seeing in the news absolutely can expand opportunity, or they can expand risk. It depends on whether you treat home buying like a strategy or a scramble. If you think these changes could help you, grab my free buying guide. The link is in my bio, and plan your path forward. Make sure, regardless, that you share this with someone you know that's considering buying so that they understand what